I'm going to show you some, actually I've got three gap downs in this video that I'm going to show you, and I'm going to relate the signals for those gaps down and how they work in relation to the price, or more importantly how the indicators work in relation to what is anticipated. In this first example that I've got here, the vertical green line shows us that we have in this case we have a red candle, and we're in a second peak, and by that I mean and you can recognize divergence on that peak. For example, if you look at I'm going to draw in another vertical line. If you look at this peak right here on the red vertical line, you will see that that red peak is lower than this red peak over here as far as value is concerned. The candle is bigger or higher than it is. It's over the 200 moving average here. Over here it's under the 200 moving average. However, if you look at the trend red, you see that the peak on the right 5 days later is lower than it is on the left. And so basically what you have is price divergence between the price and the trend red line. And that obviously is divergence, but it is a real strong indicator for something to come up in, and this is one of those cases where the gap occurs on the 2 days or after, on the third day actually, after the divergence was identified. And you obviously would have or should have got into that trade immediately the next day, but the power of that thing is going to occur on the third day, on the day after the vertical green line with the gap down. Now, what happens on the vertical green line, which is the day before the gap, we have trend blue is highest and all the other lines are under it. And we're obviously after the divergent move that just took place with the price peak going up with the trend red line down. Green was down as well, and gray was up. So the 5-day movement of gray to gray is up. The 5-day movement of trend red is down, and green is down. So there's divergence between gray and red as well there. And we have divergence from the perspective that we have line divergence. And by that, or line difference, by that I mean if you look the day before the red vertical line, you have trend gray at 25. On the red vertical line, trend gray is 28. That's 3 points. On the day before the red vertical line, trend red is at 7, and on the vertical red line day, trend red is at 28. So trend red has moved up 4 times its own value if you look at the difference in the indicator. If you look at the difference in what the other indicator moved, in other words, trend gray moved 3 points, and the difference between the 7 to 28 is 21. So that's a 7 times movement. So the gray line times 7 would be equivalent to the trend red line. And this is the difference that we're talking about, because there's a lot of ways to calculate differences. But this is a line length diff divergent indicator or indication. And you can recognize when that happens, when you have that. It's usually when you have, it'll work fine at 3 times or 3x times. But in this case here it's 5 times. You can see it 7 times or 10 times. Whenever it's over 3, there's usually something significant that's going to take place. It's just that difference between the lines, and that's the general way to calculate things on the trend gray and trend red relationships. Also, when you do have divergence in trend gray, you typically have trend gray up and trend red and green down. Trend red and green usually go in the same direction. If green goes in the same direction as trend red, I said that wrong. If trend green goes in the same direction as trend gray, then the movement tends to typically be weaker. Now, this is obviously is divergence in what we have here. If you look at the vertical green line here, we have price green highest, and everything's going down. But we also have trend red. Let me move this. Trend yellow. Excuse me. We also have zip yellow highest and going down, with power yellow highest and going down on the vertical green line day. And this is the yellow twins pattern. When those two are both highest and both going down, we're in a downtrend. And so this becomes, in a gap analysis situation, this becomes a pattern that we identify that tells us that price is going to go down. It's different than the other patterns that we have. For example, if you look at the identical patterns that we have right now, the shape is a TOC 2-day pattern. Trend red is up 1 day and down 2 days. If you look at the rest of them, you got trend red, green, and gray in that TOC 2-day pattern. You have yellow, pink, white, blue, and Zion, which makes a total of 8 right there. There's 5 in the power chart, 3 in the trend chart. You have swing yellow in the same movement. You have swing Zion and swing pink in the same movement, so that's 11. You have zip red, yellow, blue, gray, and pink in the same movement. And so there's 11, about 17, there's about 20 indicators, maybe 21 if my count was wrong, indicators in a 2-day TOC pattern that gives us a one pattern grouping of identical indicators telling us that this is a possible gap down. When we look at the up touches or the down touches in obviously when we're considering a down touch, we're looking at the up touches that might occur. Trend green up touches blue, and trend red actually up touches trend gray, although we don't necessarily think of that as an up touch. What trend red has actually done is it's referred to as what we call a nose out. It sticks its nose out above the blue line, and next day it goes down. It's just like the pattern that we have when it goes in the opposite direction. When we have trend red that crosses over 0 or crosses, excuse me, I said that wrong. When it crosses under 0, or if the trio is under 0, then it'll cross under blue and stick its nose out. The next day it comes back up. The condition for that specific pattern is that it reverses on the day after the cross day, either cross over or cross under. And that's exactly what the trend red did here. It crossed over the blue line, stuck its nose out, and bingo, it goes down the next day. The situation there on the red vertical line is that power yellow is highest, and so that's a good situation to be in. Power Zion is up touching the power orange line, which tells us it's going down. So we've got a lot of up touch situations inside of this thing. Or I guess we have one more, that's all that I can identify with at the moment. That one more up touch in the power Zion, but that one, as you know, is a very powerful line. We always use power Zion to compare divergence between it and the power 4, the blue, pink, white, and yellow, or the power 3, which is minus the yellow. So in this particular example, we have on this green vertical line, we have trend red that has crossed under the green now for the second day, but here again we have big diff divergence. Trend green on the green vertical line day is at -2. Trend red on the green vertical line day is at -21. So we have a -19 difference, or a spread difference of 19 points between the two, and that is big. And what that's telling us is, even though the price didn't move that much when we look at the red candle on the vertical green line day, we know that there's much more strength there because of the big separation between trend green and trend red. If you look over here, a couple days before the red vertical line, green is at 9, red is at -1. So there's a 10-point separation between the two. And that's obviously half of what it is over here on the green vertical line day. And that is a real good way to identify strength. It's referred to as diff, D-I-F-F, or capital D-I-F-F, and it's actually a diff divergent condition. It's part of the divergence that we see, but it's a divergence in diff analysis. The same is true when you look at this red vertical line. Trend red the day before is at 7, and trend red on the vertical line day goes up to 28. So it's jumped 21 points. The green goes from 9 to 17. It jumped only 8 points. And so red almost increased 3 times. If it would have been 24 instead of 21, it almost increased 3 times what green did. And so we like to use as a basic formula 3 times, or 3x. But even so, if I saw that, especially when I saw that trend gray was in a low angle up, which tells us that it's going down the next day, that I would have shorted immediately at the open next morning and captured that red candle, and then hopefully hung on to it through the gap down. Sometimes you see things, you think you're always going to find a better deal in some other indication, but if you remember, divergence doesn't necessarily happen next day. And this is a classic example of it happens on the 3rd day, because it was the day after this vertical green line that the divergence occurred that we saw on the red vertical line day. And and now and also I mentioned them already, but I want to emphasize that these other patterns, the power yellow highest and the zip yellow highest, those twins being highest, are a complete additional pattern telling us that price is going to go down. And when you have complete patterns that do that, that is a better emphasis of movement downward. One other big thing that I'll comment on the zip chart right here on the vertical green line, zip yellow and blue have gone down for 2 days, but zip yellow is at 58. And notice how far green and gray, how far red and gray have gone down. Red is at 22.22 and gray is at 22.22. So right now red and gray are identical, but they're at 22, yellow's at 58. Now that's a pretty big difference. When you have that separation between the 0 and you have a 30-point separation, it's usually indicative of a continuation down, because red and gray move faster, move quicker. They have longer line length. It's just like this. The 2 days before the vertical green line, you had a doji, a T-top doji candle. The day before the vertical green line, you had a little red candle. It closed at 268. The day before that, it closed at 275. So it dropped down 8 cents, but yet trend red went from, I said that wrong. Zip red went from 93 down to 27. So Zip Red dropped 70 points, and yet the price dropped 8 cents. That is a real strong indication of more to come. So those are some diff examples of what we see. There's 3 examples I have. Here's the second one. In this one here, we have a high M pattern. The price is actually higher than it was the day before, and the trend red M is higher. The right peak is higher than the left peak, but just barely. I looked at it a little bit earlier. The trend green obviously has a much bigger, you can see it much more readily. It's the peak on the trend green is much higher. There's a huge divergence taking place here between my favorite 2 indicators, trend red and power red, and you can see power red is in a super low high M right peak pattern. The red peak just never came up at all, and so that's real indicative of a upcoming down movement. And there's extreme divergence between trend red and power red. And again, as you know, those 2 are 2 out of the 3 big 3 pattern indicators. Swing Zion over here is the other one. Swing Zion is in a lower high M pattern. The right peak is lower than the left peak. And then look at the divergence you have between Swing Zion and Swing Pink. Remember, Swing Zion is your price indicator moving with the price. Swing Pink is a leading indicator telling us what's going to happen with the forces. And so Swing Pink and Zip Red are the 2 quickest indicators in the whole system. And so with Swing Pink only going up a little bit, Swing Pink went from minus 0.56 up to minus 0.37. So it goes up about almost 0.2, but again, that's 0.2. Whereas Zion went up over 0 and it moved a couple points. Zion went from 0.44 to on the green vertical line to 1.1. So I guess it moved up about 1.5 points. But still, that's 8 times, 7 times what the pink line moved up. And again, you have that 3x factor, that 3 times factor. When one of those lines has a different spread of more than 3 times, that's usually a strong indication of something to come. But the second most powerful signal on this entire chart is in the price green and price red lines. The first one is the trend red to the power red divergence. The second one has in the left peak, the left M peak, price green is under price red. So price red is highest on that peak. On the vertical green line, the right peak is lower. Both of them are lower, but red is under the green. So you have a color divergence. The red peak is higher on the left peak and lower on the right peak. And that little fact right there is a huge signal for a gap down. I mean, we set that signal in our scanner just as a individual signal to identify gaps down. And you can too. I think I've got that set as a single indicator in the development environment. One of those 400 or 500 indicators that have been built and created for quick use. That is pre-built in the system. If you can't find it, just take there's other ways. I can't think of the exact indicator that's built there, but you can use a couple of different indicators to create the same thing. Now, that's the second example that I have in locating or in identifying this particular one has divergence. Also, this particular identical group or identical pattern is a BOC pattern. And we can see that because it's a high M pattern, and some of them are higher and some of them are lower. Like all of your zip lines are lower, your Zion is higher, your trend red is higher, green is higher, but you have a mixture of high M higher patterns and high M lower pattern in this particular situation. And I didn't count them, but there's probably 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, and there's probably 17, 18, 19. So there's quite a few, I think, identical patterns. Sometimes we look at the identical patterns, whether they're higher or lower, as the same thing. But again, if you use the radar screen identical indicators like the shapes pattern, or the 22 columns of the 22 MFR indicators, those will show up either as a high M higher or a high M lower with a little bit different color. By the way, when you're on the box color alerts in the radar screen, like if a BOC is a green pattern and a 2-day BOC might be a dark green pattern, so the shades, the green and the dark green, are the same indicator in a little bit different format. And that theme runs throughout the radar screen indicators. In the third example here, and the last one, is again, it's the same as the first one. Let me flip back there for a second. In the first one, we had a 2-day TOC pattern, up, down, down pattern. In this pattern, as I switch over here, we have the same thing. So what I'm trying to tell you is that oftentimes in gaps down, we have a 2-day TOC pattern. So that's a shape pattern that has repeated itself, and it does so often. The one thing that I have not, that I'm going to go back and forth and explain, is that typically when you're talking about location, for example, the location pattern of the power lines, the Zion is above power orange, and the power 4 is under power orange. All 5 of those lines are in a 2-day TOC lower pattern. Now, that being said, Zion is above orange and the power 4 is under orange, but all 5 lines are under 0. And so their location is under 0. Oftentimes when you have a gap up pattern, the power 4 will be above 0 or above the Zion, the power orange line, and power Zion may be under the orange versus above the orange, but if it's above the orange, it's certainly a gap up situation as well. You seem typically to get more power in the gap up if the Zion line is under power orange and the power 4 are above power orange when you're looking at gaps up. And so generally speaking, gaps down will have the power lines underneath 0, and gaps up will have the power lines above 0. That's real general, but that's one way to look at it. Also, in this situation, we see trend gray in a peak pattern. With a low angle down peak pattern. Low angle down is stronger than low angle up, but much more important than that is the trend peak pattern is occurring under 0. That is extremely divergent. That is extremely powerful to have a peak under 0. When you have that, you have a situation that just shouts, I'm going down the next day. Added onto that, you have trend red that is in a BOC lower pattern, and it has crossed under trend green to start the downtrend. And so you have trend red and green in 2 patterns in one movement. Red's a TOC lower and which is more powerful on a peak, and trend red has crossed under green, which means it's starting the downtrend. And so you, in this case here, red and green are only a few points apart, but they have that double whammy that's taken place in the TOC lower and the cross under green at the same time. The power 5 lines, Scion is in a 2-day up down down pattern, a TOC 2-day pattern, but it's above orange and under 0, and the power 4 lines are all in a 2-day pattern, 2-day TOC pattern, all under orange, which again is indicative of a downtrend. Similarly, we have a pattern over here in the ZIP chart on this green vertical line. We have ZIP Zion highest, and this ZIP Zion highest, and one of the red peaks or red spikes is often some of the other additional patterns or extra patterns that we see. We call them, in gap analysis, we call them supporting evidence. And so ZIP Zion on the green vertical line is at 14. And so ZIP Zion is highest at 14. Now think about that. ZIP red will move 60, 70, 90 points in a few minutes, and it has no power to be up above. So what I'm saying here is there is a huge amount of power pushing this thing down that's picked up by the indicators that does not reflect in the candles. And that's the difference in the sensitive indicators. And just like when we look down into the swing chart, we have the normal situation with remember, when the swing blue crosses under red, it's typically the weak start of a downtrend. When swing blue crosses under green, it's a stronger downtrend. And so trend right back here about 1, 2, 3, 4 days before the vertical green line, we had trend blue cross under trend green to start a stronger downtrend. And obviously the candles did go down, okay? But along the same lines, on this vertical green line day, ZIP Zion stuck out as the highest and reflected the pressure of the other indicators reflecting downward pressure, and thereby they are under the ZIP Zion line, telling us that the movement is going down. So it's just like anything else. And also look at on the green vertical line day, ZIP yellow is at 2.3. Remember, when ZIP yellow is down low, if it's not going to go up, nothing else is going to go up. If you've had a chance to see some of the signal, the videos on signals, you recognize that you need to verify your signals with your ZIP yellow line. Because when ZIP yellow gets roughly above 35, when it gets in that 30 range, then the value of the price of the stock starts going up at a better rate. And as it passes 40, then when ZIP yellow passes 40, then it has a tendency to move price up at a much stronger level. And then of course, if it's going over 50 or up above 50, it's obviously prices are then moving up, not down. But when ZIP yellow is down under 5, things are going down. So from the trend red peak, from the trend gray peak in the trend chart, or from the trend red cross under green and the BOC and the TOC lower pattern, I mean, there's 1, 2. Location-wise, you have all 4 lines under orange. You have the pink Zion again going down. It's actually creating a bottlenose pattern. It's a low angle down. You could say, well, it's a bucket going back up, but it's pretty hard to. I mean, it's one of those things where that's one possible indication based on all the other information that we have. But when you have all of that other information, then you can typically look at Power Zion as a bottlenose. And that, in essence, is what it ended up being in this particular case. Continually, swing gray went down, 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 down until we had that strong gap. Red and green were separating themselves, getting wider and wider apart. They do that when things happen, when they're under zero and things are going down, they just get farther and farther apart. But that's the general ideas we have with that particular video are on those 3 gaps down and the signals that go along with those 3 gaps down. Everything is conditional. The more evidence you find, the better the deal you're going to get. And it's just a matter of searching through the information. I'll just comment briefly on the radar screen box color alerts. You can go to the down touch, the 6 down touch patterns. All 6 of those patterns will be marked